Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Kroger stock so we can determine if it's a buy or a sell. Kroger is the largest supermarket chain in the US. The second largest is Albertson's. We'll be doing that video next. And the company has been around 140 years. That is not a mistake. They started in 1883. Let's get started with the model. This is a large cap company, 34 billion market cap. They're trading at $47 a share, and they have 713 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had $4 billion of free cash flow in 2021. But it seems to be going down each year. It went down to $3.6 billion in 2022, way down to $1.2 billion in 2023. Then it more than doubled in the trailing 12 months to $2.7 billion. Sometimes a company can have low free cash flow if they're investing a lot back into their business, meaning they spend a lot on CapEx. If they open up new stores, that's a CapEx spend, because if they buy the real estate, they have to capitalize those expenses and depreciate the cost onto their income statement. But if they lease a location, they don't have to capitalize it. It doesn't affect CapEx. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's fairly steady. $2.5 billion in 2021, $2.5 billion in the trailing 12 months. It did go down in 2022 to $1.7 billion. There might have been write-downs that year, asset impairments, which brings down your net income. Revenue is a sales for the company, and that looks really good, $132 billion to $149 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $52 billion. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $48 billion. We divide that by 713 million shares. And we get a calculated stock price of $67. They're trading at $47, so they're trading at a 30% discount. It's a pretty strong buy according to the model. Here's their latest 10Q as of 5/20/2023. Let's take a look at their income statement. For the 3 months ending 5/20/2023, revenue of $45 billion. Up a little from $44.6 billion. Let's get a breakdown of the $45 billion so we know what it is. Here's the only breakdown they provide. Sales of $5.1 billion for fuel. They have gas stations at some locations. But fuel sales is down from last year. Last year was $5.9 billion. It's down 13.5%. Non-fuel sales is $39.7 billion. Up 3.4%. If you assume inflation is 5%, it's actually down 1.6%. So they have less revenue than last year. $320 million of other sales. That's footnote 4. Let's see what other sales are. Other sales are external sales at food production plants, data analytics services, and third-party media revenue. In order to generate the $45 billion of revenue, it cost them $35 billion. Because they do have to buy the products, buy the toiletries or food or whatever products they sell. They also have to pay their employees, and they mention advertising, transportation, lots of expenses. Then you have operating, general, and administrative expenses, $7.4 billion. They do talk about their OG&A expenses. This is mainly employee-related costs, such as wages, healthcare benefits. It also includes utilities and credit card fees. Because every time a customer uses their credit card, they have to pay a 2% fee or something along those lines. They're a big company, so they probably don't pay as much in fees as a smaller company. When I had my own business, I paid about 3% to the credit card companies. Rent, depreciation, amortization, and interest expense are not included in OG&A. In this current quarter, OG&A was 16% of revenue. Last quarter, it was 15.7%. As you know, we're in a high inflationary environment, so expenses are growing. It looks like they separate out their rent expense. Rent at their stores is $265 million. But if they own the location, they don't have to pay any rent, but they do have depreciation. They only have one sentence for rent. Rent remained consistent as a percent of sales when you compare this quarter to the quarter last year. The next expense is depreciation and amortization, $957 million. D&A increased as a percent of sales. The increase was finance leases related to their fulfillment center openings. Additional depreciation on capital investments, excluding mergers and lease buyouts. They also had a decrease in the average useful life of these capital investments. When the useful life of an asset decreases, that means depreciation in a particular year increases because there's less years to spread out the depreciation expense. If you had $100 million of depreciation expense over 100 years, that's $1 million of expense per year. But if you decrease the useful life to 50 years, now it's $100 million over 50 years, so it's $2 million per year. It's the same expense, it's just spread over a shorter time frame. So their operating profit is $1.5 billion, a little lower than last year. Operating profit is 3.3% of revenue, down from 3.4%. As you know, supermarkets have really low margins. Then you have interest expense of $153 million. Last year was $177 million. They talk about it here. Interest expense decreased. This decrease was mainly due to increased interest income earned on our cash due to higher interest rates and an increase in our investments. Say, for example, they pay $200 million of interest on their debt, and they receive $50 million of interest on their investments. Their interest expense will be $150 million. Some companies have a positive interest expense because they receive more on their investments than they pay in their debt. They had a gain of $9 million on their pension benefits and a loss on investments of $78 million. It looks like that loss is tied to Ocado. They're investing in this company, and if Ocado reports a loss on their income statement, then this company has to report a loss of their proportional ownership of Ocado. That's called equity method accounting. Usually a company uses equity method accounting when they own between 20% and 50% of another company. If they own more than 50% of another company, then they would consolidate that company's financials onto theirs. Ocado is a British business. They license their technology to grocery stores. Kroger is mentioned on the Wikipedia page of Ocado. In 2015, Ocado launched the Ocado Smart Platform. It's a proprietary end-to-end solution for operating retail businesses online. So Kroger probably uses this company's technology for their online platform. So a lot of big companies use Ocado's software. You could look in Kroger's 10Q, and it does talk about Ocado. On May 2018, the company entered into a partnership framework agreement with Ocado. Ocado will partner with the company in the US, enhancing the company's digital and robotics capabilities in its distribution networks. In the first quarter of 2023, the company opened one additional Kroger delivery customer fulfillment center in Frederick, Maryland. The company determined the arrangement with Ocado contains a lease of the robotic equipment used to fulfill customer orders. Let's go back to the income statement. EBT, earnings before taxes, $1.2 billion. Taxes, $286 million. You can even learn what the company says about their taxes. The effective tax rate was 22.9%, 18% last year. The difference was due to state income taxes offset by tax credits and deductions. Their net income is $962 million, EPS of $1.33. Last year was 91 cents. Last year they had 722 million shares outstanding. Now they have 717 million. And the EPS per diluted share is $1.32. Last year it was 90 cents. If all the convertible debt converted to equity, they would have 724 million shares outstanding. Let's see how much cash they generated from their operational business. This is their statement of cash flows, which is pretty hard to read. Operating cash flow is the first section on the statement of cash flows. It tells you how much cash the company generated or lost from its operational business. Even though they reported an accounting profit of $960 million, they actually generated $2.9 billion of cash flow because there's a lot of non-cash items on the income statement. Last year was $1.1 billion of cash flow. And that's how they pay dividends and buy back stock from cash flow. Net income is an accounting number. It's really important you understand both net income and cash flow. Let's look at the stock on Simply Wall Street. Its last price was $47, $34 billion market cap, down 3% in the past year. Kroger operates as a food and drug retailer in the United States. Here's some of the risks. High level of debt, significant insider selling. Here's the stock price since 1990. Its highest was $61, and that occurred in 2022. It had a big pop in 2016, and then from 2016 to 2020, the stock did struggle. And it hit $20 in 2020, and then tripled the next 2 years. It has been regressing the past year and a half, as most stocks have been. Here are some recent news and updates. On June 15th, first quarter 2024 earnings, EPS misses analyst expectations. Kroger is still a buy if you look for long-term stability. Flat year-over-year earnings expected, but shares are on sale. Upcoming dividend of 26 cents, which is a yield of 2.2%. Here's their PE since 2018. It was 6.7 in 2018. Its highest was 31 in 2021. But the stock has been going down, so the PE looks more attractive now. It's sitting around 14. And their price to sales is always really low. It's either 0.2 or 0.1 for the past several years. Their price to book in 2018 was 3.4. Then it fell to 2.1 in August 2019, up to 3.7 in May 2022. Now it's currently 3.3. Simply Wall Street's valuation is $90. They say the stock is 48% undervalued. 20 analysts priced the stock and the average price target is 52. They say the stock is 11% undervalued. Their trailing 12-month revenue is $149 billion. The forecast is for the revenue to grow very little to $151 billion by January 2026. In 2012, their trailing 12-month revenue was $93 billion. As you can see, it grows a decent amount each year. They hit $100 billion in 2014, $123 billion in 2018. It did come down a little bit in 2019. They broke through $130 billion for the first time in November 2020, and it's getting close to $150 billion. This is their actual revenue for the trailing 12 months. You should always make sure a company can cover their interest payments at least 2 times. They can cover it 9 times. So they can cover their interest expense with their operating income 9 times. Their debt to equity ratio is 105%. So their debt is pretty much equal to their equity. You can see their debt is $11.4 billion, equity $10.9 billion. That's why it's slightly over 100%, because debt is slightly higher than their equity. In an article in April, it says Kroger seems to use debt quite sensibly. Does Kroger have a healthy balance sheet? Can they manage their debt responsibly? This red line is their debt since 2012. The blue line is their equity. So it always seems like their debt is higher than their equity. But it has improved because their equity has gone up over the past 11 years. Even though their debt has increased, their equity has increased more. So now they're almost identical. You can see they raise their dividend each year. They were paying 23 cents a share in 2012. That's for the whole year. Currently it's a little over $1, and the forecast is for it to grow to $1.40 by 2026. The yield is a little more volatile because it's tied to the stock price. It was 2% in 2020. It peaked at 2.5% in 2019. It came down to 1.5% in March 2022. But the forecast is for the yield to grow to 3% by 2026. The CEO's salary is $1.4 million, total compensation $19 million. And the CEO has been with the company 9.5 years, a decent tenure. In the past 12 months, there's been no insider buying, just selling. You generally want to see insiders buying, not selling. 73% of the company is held by institutions, 19% by the general public, and 7% by public companies. Vanguard is the biggest shareholder at 11.5%, 83 million shares, valued at $3.9 billion. They do employ a lot of people, 343,000 people in 2013. It looks like it peaked in 2021 at 465,000. They did cut some people down to 430,000 currently. And the ticker trades on the New York Stock Exchange, Deutsche Börse, Xetra, Mexican Bolsa, London Stock Exchange, EuroTLX, Wiener Börse, and Sao Paulo Bolsa. Next, we're going to look at Albertsons, the second largest grocery chain in the US. They were founded way back in 1939, nearly 200,000 employees. Let's get started with the model. This is a large cap company, 13 billion market cap. They're trading at $22 a share, and they have 577 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They only had $400 million of free cash flow in 2020, Could be from lower sales from COVID. It jumped way up to $2.3 billion the following year, down to $1.9 billion, and now it's $700 million in 2023. They recently completed their 2023 fiscal year. Their fiscal year ended February 28, 2023. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that almost doubles from 2020 to 2021, then almost doubles again from 2021 to 2022, then declines a little bit into 2023 at $1.5 billion. Revenue is a sales for the company, and that looks really good, growing each year from $62 billion to $78 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $22 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $20 billion. We divide that by 577 million shares. And we get a calculated stock price of $35. They're trading at $22, so they're trading at a 39% discount. It's a strong buy according to the model. There are 12 companies in the same industry as Kroger and Albertsons. And if they have a number in red, they're worse than the median. If they have a number in blue, they're better. Both companies spend a lot on CapEx. Kroger, $3.2 billion. Albertsons, $2 billion. Albertsons is really leveraged. For every dollar of equity, they have $9.30 of debt. Kroger's debt to equity is better than the average, but a little worse than the median. They both pay a fairly healthy dividend in the low 2% range. Kroger generated a lot more free cash flow in the past 12 months, $2.7 billion. Albertsons, $700 million. Kroger is easily the largest company on this list at $33 billion market cap. Albertsons, second largest. They both have a price to book worse than the median and average, but their PE, price to free cash flow, and price to sales are both better than the median. So this implies they're at a good value. They would be considered a buy according to the price multiples. Kroger generates a ton of revenue, but relative to their market cap, they both generate the same amount of revenue. About 20% of their revenue is their market cap for both companies. Kroger is growing at a 4% rate, Albertsons at a 5% rate. Here's their 10K. They released it in February of 2023. Let's look at their income statement. This is for 2021, 2022, and 2023. They had their highest revenue in 2023, $78 billion. Let's get a breakdown of that number. Of the $78 billion, $39 billion was from non-perishables. This is general merchandise like toilet paper, also grocery, dairy, and frozen foods. Fresh items, $26 billion. That's produce, meat, deli, and prepared foods. Pharmacy, $6.8 billion. Gasoline, $4.9 billion. Other, $1.3 billion. Other is wholesale revenue. Half their revenue is from non-perishables. That was 54% in 2020. Even though their revenue is higher than 2020 for non-perishables, it's not growing as fast as other categories. Pharmacy was 7.4% of its revenue. Now it's 8.7%. And fuel has doubled. It was 3.2%, now it's 6.3%. Fuel had the largest growth on a percentage basis. And I think even a dollar amount basis, it grew the most because it grew $2.6 billion from 2020 to 2022. Their cost of revenue is $56 billion, so gross margin $22 billion. Let's look at this income statement instead because it has percentages. Their cost of revenue as a percent of revenue is 72%. It was under 71% in 2020. So that means they have lower gross margins. Gross profit is revenue minus cost of revenue, $21.8 billion. So their gross margin is 28%. They convert 28% of their revenue into gross profit, which is lower than 2020 of 29.3%. SG&A, selling, general, and administrative expenses. These are all the expenses not directly related to generating the revenue. That has gone down as a percent of revenue. It's down to 25.2%. It was as high as 27%. They probably cut a lot of staff. That's a good way to reduce expenses. They give more info on SG&A. SG&A consists primarily of store-level costs, including wages, employee benefits, rent, depreciation, in addition to certain back-office expenses related to our corporate and division offices. The decrease in selling and administrative expenses was mainly due to the benefit of ongoing productivity initiatives, lower COVID-19 related expenses, and sales leverage, partially offset by incremental legal and regulatory accruals and settlements, higher employee costs, investments related to the acceleration of our digital and omni-channel capabilities and merger-related costs. The increase in employee cost was the result of market-driven wage increases and higher equity-based compensation. They had a gain of $148 million on property dispositions and impairment losses. If this number was positive, it would be an expense. Since it's negative, it's a gain. For fiscal 2022, net gain on property dispositions and impairment losses was $148 million. That's mainly driven by $153 million of gains from the sale of real estate assets, partially offset by $5 million of asset impairments. So if they own some of their locations and they close a store and sell the real estate, they may make money on that. Operating income of $2.3 billion, down from last year, but a lot higher than 2020. Interest expense of $405 million, which is a lot better than prior years. The decrease in interest expense was due to higher interest income, as well as lower average interest rates. Last year, they were paying 5.5% interest on their debt. Now it's 5.3%. Then you have $33 million of other income, EBT of $1.9 billion, $422 million of taxes, net income of $1.5 billion. Their net profit margin is 2%. Last year was 2.1%, but 2 years ago was only 1.3%. EPS of $2.29, a lot lower than last year. Here's how they calculate the EPS. It's net income over shares outstanding. They added a lot of shares. They have 529 million shares. Last year it was 470 million. When companies expand, when they buy other companies, sometimes they add shares to finance that growth. So to get to 229, it's 1.2 billion over 529 million. Let's look at their operating cash flows. The way to calculate operating cash flow, you start with your net income, 1.5 billion. Then you add back the non-cash items on the income statement. We add back 1.8 billion in depreciation and amortization. Then we have to adjust for changes in working capital. So if they buy inventory, that's a cash outflow. They bought 549 million of inventory. For the year, they generated 2.9 billion of cash flow, which is lower than last year of 3.5 billion and lower than the year before of 3.9 billion. It looks like they got a big boost in 2021 from 672 million of pension withdrawal liabilities. When the pension pot is being funded, it's a cash inflow in that accounting period. But in the most recent year, they paid out over 100 million of pension benefits. So if a lot of people are retiring in a given year, you'll see a negative in this category. Let's look at this company on Simply Wall Street. Its last price was $22, 12.5 billion market cap, down 24% in the past year. Albertsons, through its subsidiaries, engages in the operation of food and drug stores in the U.S. Here are some risks: high level of debt, unstable dividend track record, significant insider selling. Shareholders have been diluted in the past year. We saw that when we looked at their income statement. Their shares outstanding went up a lot in the past year. They recently IPO'd in 2020, and the highest stock price was $37. That was in December 2021. And I think the stock is down around 40% from the peak. I was really tempted to buy the stock at IPO. If I did, I'd be up about 25% right now. Here are some news stories. April 27th, the chief operating officer sold 2.6 million of stock. Chief accounting officer sold 680,000. Upcoming dividend of 12 cents. That's a yield of 2.3%. Here's the historical PE. In September 2021, it was 28, but the stock has been coming down, so the PE is under 10. The price of sales is always 0.1 or 0.2. When they IPO'd, their price to book was 4.5. It was as high as 14. It looks a lot better now at 7. Simply Wall Street's valuation is $43. They say the stock is 50% undervalued. 14 analysts priced this stock, and the average price target is 25. They say the stock is 16% undervalued. Their trailing 12-month revenue is $78 billion, and the forecast by 2026 is $82 billion. In 2015, their revenue was only $27 billion. It more than doubled the following year to $59 billion. They must have did a big acquisition. And since then, it's been growing. It's up to $78 billion currently. Their debt-to-equity ratio is 500%. Debt of $8.39 billion, which is 5 times their equity of $1.66 billion. They could cover their interest payments 5.9 times, so that's good. Historically, they've had a lot more debt than equity. In 2016, $11 billion of debt, $1.6 billion of equity. Their debt has come down over the years. It's down to $8.4 billion. In 2018, their debt-to-equity ratio was over 800%. They did bring it down to 345% in 2019, but now it's back to over 500%. Their dividend yield is 2.2%, payout ratio of 21%, so they can cover their dividend payment 5 times with their earnings. Dividends per share of 48 cents, earnings of 210. The industry average is 1.6%. Here's their dividend per share since 2020. It was 40 cents. The forecast is 60 cents by 2026. And the yield was 2.6% when they IPO'd. Then it fell to 1.5% in 2022. But the forecast is for the yield to be 2.8%. The CEO's total compensation is $16 million. He's been with the company 4.2 years. But his actual salary is $1.5 million. The $16 million is if you include all the benefits. In the past 12 months, only insider selling, no buying. Lots of big sales, 34 million shares, 11.5 million shares. 48% of the company is held by institutions, 26% by VC firms, 18% by the general public, 5% by private companies, and 3% by insiders. The private equity company Cerberus owns 26% of the company. My friend used to be a controller at this company. They own over 150 million shares valued at $3.3 billion. They used to have a lot more employees. In 2017, 270,000. It was 300,000 in 2021, but it looks like they got rid of a lot of people or sold off part of their businesses because they're down to 200,000. The company trades on the New York Stock Exchange and Azitra. So we're all done. Let me know what you think of the video. Leave a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.